I mean, fundamentally, we're seeing strength out there in terms of in terms of, I think, earnings was going in 2019. But I think valuations got ahead of themselves here. You're seeing the risk-off trade. It's been a white knuckle period. We still think in tech stocks, you could see another, call it 2 to 5% downside. But then ultimately, I think these things rip higher going into year end.
When you say valuations, we've been talking so much about this idea that interest rates have been playing so much into the valuation discussion, especially for tech. Because as interest rates rise, the metrics and the inputs that you value stocks by start to change. As an analyst, when you assign a target price or a level or a buy recommendation to a stock, how much of that interest rate picture is playing into your thought process?
Yeah, look, it's definitely obviously a factor. And I think the most important thing, too, is about growth and overall metrics in the market. I think what's happened right here is that in tech, given the secular growth names, you're starting to see just transformational growth that we've never seen in the last, call it, decade. When you look at cloud computing, cybersecurity, big data. But in terms of valuation, you're starting to see those valuations get stretched. And now what's starting to happen is you are seeing a compression, the risk-off trade. So that's why as a tech analyst, I think someone's covered it the last 2 decades. You look at historical metrics relative to growth. And that's where you know where it's time to pound the table versus times where this thing could continue.
So your job is to assign target prices, buy, sell, hold recommendations. Within your coverage universe, I mean, there's a lot of big names in there. Given what we've seen in the last 2 days, what represents the most attractive opportunity to get in and perhaps either start building a position or add to ones that you already have?
Yeah, I would definitely encourage when you look at the trends, you've seen consumer names very weak in terms of social media and some of the traditional FAANG names. But when you look at enterprise, I think there's just some secular themes on cloud computing, on big data, on cybersecurity that we believe are sort of the areas that investors should really be focused on. The other thing I'd point out is that if you look at the softness that we've seen with some high flyers down 30, 40%, I think it's really going to be a catalyst for M&A here in tech. So I think that's something where I think you have a lot of boards and CEOs right now sharpening their pencils, looking at some of these tech stocks that are down 30, 40, sometimes 50%, that could be a catalyst for M&A.
When you look at those tech stocks that are down a lot, many of them over the course of the past 5 or 6 months have been semiconductor related. As a technology-oriented analyst, is that one of the tea leaves that you're looking at, whether or not the momentum can shift for many of these once high-flying stock names in chips, and whether or not that bodes well for the overall sector?
Well, yeah, and there's no doubt the brush fire has really been the China-U.S. trade wars. Because I think the bigger worry here is if you look at semi and that whole semi trade, like as that's starting to sort of wane here, and there's risk in terms of U.S.-China as well as just overall valuations, that brush fire is spreading. So I think you're looking at semi names, how they react over the coming weeks. You look at inventory levels, what's happening on the smartphone side, because ultimately from a leader perspective, semis have been front and center, and I think that's really what's caused investors to really worry here on tech stocks. But ultimately, 3 to 5% downside on tech, more, and ultimately these things could rip 10, 15, 20% higher into the year end.
All right. Well